Welcome to Pankinen Financial Perspective with Ashton Pankinen from Pankinen Financial Group. Planning for your financial future means navigating challenges like market volatility, inflation, and retirement income. Pankinen Financial Perspective is here to help by addressing common financial concerns, sharing valuable strategies, and exploring ways you can work toward your financial goals. Now let's get started with Pankinen Financial Perspective.
Hello, and welcome to the Pankinen Financial Perspective with your host, Ashton Pankinen. If you'd like more information about what you hear during our show today, give us a call at 952-873-2703 or visit us online at pankinenfinancial.com. That's PANKONIN financial.com. And while at my website, click on the radio page to check out past shows or to subscribe to our program on Apple Podcasts, Spotify, or Amazon Music. Also, while at my page, click the link at the top to get the latest retirement guide. Today, we're going to talk about some timely topics, tax season and investment strategies, the theme there. I'm really excited to be live in studio with Tony Shore, getting a video recorded of this as well. So we're excited.
Yeah. I mean, usually we're not in person. You're in your studio. I'm in my studio up here in beautiful Arden Hills, Minnesota, and you're in lovely Belle Plaine. So correct. Yeah, I think that's great that we get to do it together today. We're here live from the Gradient Financial Center, and we have some great podcast studios here. This is where I normally do it from, is my own studio here in the building. So this is great. Ashton, I'm glad you made the trip up to see us.
Yeah, I'm excited. We got a little bit of a conference and some training to do to learn more to help our clients here. And so yeah, it was nice to pop in here and get this recorded.
Yeah, and you've got somebody else from your office coming in too.
Yeah, Casey Tollefson, our health insurance agent. She's going to be coming in. She's licensed in life and health, and we've got a life university here today that we're going to learn a little bit more about life insurance and get her trained up.
Yeah, and so for people who, are Medicare planning and health insurance, and nowadays you have to have a specialist like that to help you navigate it. It's crazy. I've been trying to do it for my parents, and it's not good. I will just tell you that. It's tough. I mean, they had an Advantage plan, and then I got a letter from that company just saying 3 months before annual enrollment started saying, "Oh yeah, we're not doing Advantage plans anymore." Yeah,
there's UCare's kind of exited the state. So we've been busy with that. A lot of clients that had UCare are looking for other options. A lot of people are familiar with Blue Cross Blue Shield Minnesota. We do a lot with that, and for
that's what plans. I switched. That's what I switched my parents over to. Had to. I mean, there was really no choice.
Yeah, I think I could have stayed with the UCare. I actually had UCare as well. And then I could have stayed, but I decided to move to Blue Cross Blue Shield Minnesota as well. So,
yeah. Oh, UCare's having some issues, so it's interesting to hear about what's happening there. But you're right. That's important. But today we're talking about tax season and some investment strategy themes that you wanted to. And obviously, tax time, we're in the thick of it right now. Yeah. Tax season is upon us. People are getting ready to file. And there's a difference between tax preparation and tax planning, isn't there?
There is. A lot of accountants do the tax preparation. And again, tax season, people, it's almost like a swear word as well, I think. It's tax time. Nobody likes to hear that, hey, it's tax season. It's probably even the accountants especially. It's a tough time to grind for them.
Yes.
During the year, but
long days.
Yeah, they do a lot of tax prep, meaning again, they plug in the numbers there, and then we do the tax planning on, hey, what can we do to either lower taxes in this year, the prior year, or just lifetime taxes. Yeah,
retirement. If you do something that helps you this year with your taxes, are you going to end up paying for that in retirement down the road when you really need that money? You know what I mean?
Yeah. Yeah, and so again, like one of those options is the Roth IRA.
Yeah.
You pay the taxes now and then it's tax-free.
Yeah, that's awesome.
In retirement. And so again, it's not just saving taxes on the prior year or, 2026, the current year coming up. It's also, looking at what can we do for lifetime tax savings.
That's awesome. I mean, tax season then isn't the finish line. It's the starting point. Right?
Yeah, exactly. Again, people during this tax season, they really look at it and they start thinking, well, geez, I got to do something to reduce my taxes.
Yeah.
Well, a lot of times it's too late. Depending on your situation, if you're a business owner, you may or may not be able to you can't start a 401k for last year, but you could plan ahead for 2026.
Sure.
So again, it's not just, hey, let's focus on 2025 taxes. It's planning ahead for 2026.
Yeah.
As you're sitting down and realizing you've got a pretty large tax bill for 2025 there as well.
Yeah, that's huge. So we're talking about there are hidden tax traps out there, though, that can really derail, especially if you're in retirement. But there are a lot of tax traps that can cost you an investor thousands of dollars, right?
Yeah, one of those things is the capital gain surprise. Everybody loves to see their account grow in that non-qualified space. But then all of a sudden they turn in that 1099 to the tax man and realize that, wow, we've got to pay taxes on that. And again, it's a good problem to have when you're having gains. It means your account's going up in value for the most part. But there are ways to minimize those capital gains. We have what we call a tax managed account, where they do some tax loss harvesting is what it's called.
Sure.
And so basically what that is kind of a simple analogy is, let's say Coke is down in value. They might sell Coke, harvest that loss, and then buy Pepsi and ride it back up.
Sure.
And so it's a way, again, to help minimize those gains while still getting some returns on the account as well. Yeah.
So if Google is down or Apple is down, goes down, maybe you have you have NVIDIA and it went way up, but Apple was down, then you can write off those losses and offset the gains is what you're talking about doing to minimize your tax burden.
To minimize that tax burden while still getting similar to returns as if you weren't doing that tax loss harvesting.
Sure.
But you get to keep more of your returns because you have less going to Uncle Sam and those capital gains.
Yeah, that's good. That's a good point. So capital gains surprises. And again, you can get in the weeds with these things, which is why we have you, Ashton, to handle that stuff.
Yeah. And again, on that tax loss harvesting, a lot of advisors will just do it at the end of the year. Oh, shoot, it's another year. We should maybe look at tax loss harvesting. But that's not always the most efficient way to do it, because a lot of times there's opportunities to tax loss harvest before the end of the year. So for example, April 2025, we had a big pullback with the tariffs. So we had a lot of success doing tax loss harvesting.
Sure.
At that point, in the time of this podcast, we're also looking at a little bit of volatility early on in the year here, first quarter. And so again, there's opportunities not just at the end of the year. So if your advisor's calling you to just do it at the end of the year, that's not the most efficient way to do it. And we actually have third-party money managers who do this systematically for us. So that there are opportunities throughout the year to tax loss harvest. Not just in December.
Oh, okay. What's next? What's another hidden tax trap that you have for us?
Yeah. One of the things you want to look at is, again, not just capital gains, but distributions as well in those non-qualified accounts. And then, there's some wash sale rules. So I had mentioned selling Coke and buying Pepsi.
Right.
Well, the reason we do that is it's something that's called a wash sale. You can't buy and sell the same thing in 31 days, I believe it is. Mm-hmm. Otherwise, it's considered a wash sale. And so some people would say, well, I could just sell my Coke and buy back Coke, and then I'd harvest those losses and ride it back up. But that's not the way it works. And so with that.
Well, yeah. And you don't want to get on the IRS's bad side either. Yeah. You want to make sure you're doing it all above board.
Yep.
Is there anything else as far as hidden traps go?
No, I think I want to kind of move on to some things we can do before that April 15th deadline, some smart moves, and so it's one of those things we want to get taken care of sooner than later, but we can still look at making contributions for 2025.
There's a way to do that, huh?
There is a way to do that still until your tax filing deadline, or you actually file your taxes, depending on what it is there. But so one of the things you can do is contribute to an IRA for last year, whether that's a Roth IRA where it's not going to give you that tax deduction. But your accountant does still like to track that to keep that cost basis. And so you'd want to let them know before you file your taxes.
So the deadline for an IRA contribution to still be applicable for taxes for 2025 isn't December 31st, 2025.
Correct.
They extend it to
the tax filing
the
deadline.
tax deadline.
Yeah.
Interesting.
Yeah. And so you can do that for the prior year. And so again, that Roth is going to give you tax-free growth. And so you're not going to get a tax deduction for putting it in there. And so again, let's say you make $106,000. You put $6,000 into a Roth IRA. The maximum's more than that. But again, just for easy math, you still pay tax on $106,000 there. And then if you did a traditional IRA and you put that same $6,000 in, you'd get a tax deduction for it. But you'd pay tax for it when you take it out in retirement.
Yes.
And so do you want that tax deferred growth and get a tax deduction now, or do you want that tax free growth and don't get that tax deduction? And again, everybody's situation is different. Maybe some people need that tax deduction.
Yes. You might absolutely need it this year.
Yeah.
So.
And again, nothing against accountants, but a lot of times they're looking at ways to reduce your
this
taxes
year's
for 2025.
They're looking at every possible way to reduce taxes for you this year because that's what you're basing their performance on.
Correct.
I look at my tax guy and say, I don't want to pay in.
Exactly.
I don't want to get back either. I want to be at zero. That's the ultimate because way I wasn't letting the government
have your money,
have my money and make interest off of it. Plus, I don't know. I just don't want to owe anything.
Yes.
That's my thing. Yeah.
And again, I'm not saying all of them aren't kind of looking at that, but again, we're looking at what about 30 years down the road?
Yeah.
When you're in retirement, you're going to wish you had some tax-free money.
Oh, yeah.
And so, again, do we buy that seed, pay the tax on it, or do we pay tax on that harvest?
Because if you need a big chunk for something, like to take all your kids and their kids and the grandkids to Disney World for a week, you're going to need a big chunk of change for those airline tickets and that stay, and that's Disney's money, right?
For sure.
Especially if you have a big family. My mother-in-law did that, and there were 11 of us or 12 of us. Yep. Can you imagine the air flights and the stay and all the tickets for a week? And
how long ago was that?
That was about 2 years ago. Okay. Three years ago now. Yeah.
So probably not. I mean, still expensive. Not much big difference. It wasn't 20 years ago or anything.
It wasn't 20 years ago. It was very expensive. I'm not going to say the price, but it was very, very expensive. And so she had to take out of her traditional IRA.
Yeah.
She didn't have a Roth. So she took that money out. And that put her into a higher tax bracket for the year.
Sure. Yeah.
Her CPA did not like that.
And again, that's where it's nice to have a pool of both in retirement. Whether that's non-qualified money, tax-free money like that Roth IRA, or tax-deferred money like traditional IRA. The reason we like the pool of both is to have that flexibility for income in retirement. If that's going to bump you into the next tax bracket, let's say we're $10,000 from the next tax bracket. Maybe we pull it out 10,000 of it, and we need 20. We pull 10,000 out, and then the next 10,000 we take out of our Roth IRA.
Yes.
So that way we're not bumping into that next tax bracket.
Or bumping up to where IRMA kicks in and we have to pay more for Medicare, right?
Yes.
The Medicare premiums, people think, well, they are what they are. They're $202 this year. Mm-hmm. Not if you make too much money. If you pull a bunch of money out, like let's say you bought a $150,000 RV.
Yes.
Plus the $50,000 you needed to supplement to live on.
Yeah.
You're going to be in a enough tax bracket where they're going to charge you more, right? For your Medicare premiums are then going to go up and stay up they could go up to $600+ a month.
Yeah.
From 202 to 600. That's a lot.
And again, it's that's why it's important to plan, not just, do your tax prep, but to actually make plans for that. And so in that instant, I've actually had clients who bought an RV and we did take out a loan on it so that we could stagger.
Yes.
We want to pay it off. Well, that's going to really hurt you tax wise.
Yes.
And then again, maybe bump up.
Use the bank's money, especially if you can get a decent interest
rate
loan.
Yeah. Well, and even at call it a 7% rate. If you're saving 8% federal tax, state taxes, and then again, if that's going to bump you from the 22 to the 32% tax bracket or the 12 to the 22% tax bracket, it makes sense to maybe, hey, we're going to take out that loan. We're going to pay, $50,000 this year, $50,000 in 2027, and then we're going to pay it off in 2028.
Yeah,
that kind of thing. So,
yeah.
So again, it gives you those buckets of money, give you flexibility in retirement. And again, I don't know, how long your accountant's going to be doing it, but I'm going to be with you for a long time.
Yeah.
And I want to look at that 30 years down the road scenario. Are we going to have the different buckets to pull that, whether that be non-qualified, that you pay taxes as you go, Roth, that's going to be tax-free, or the traditional IRA that you're going to get a tax deduction in the year, but then you're going to have it tax-deferred growth.
Sure. Yeah, and this is why you really need to work with a trusted financial services professional and have them and their team on your side to make sure you don't make these costly mistakes and figure all this out. The more we get into this, the more it just tells me this isn't something you do on your own and can navigate without making costly mistakes.
For sure.
Yeah. So what about tax efficient investing? We've talked a little bit about that, I guess.
Yeah. Again, we talked a little bit about that tax managed accounts. If you do have a non-qualified account, you want to make sure it's tax efficient.
Yes.
So again, you're going to get a 1099 on it every year. For people that do a lot of CD investing, they're familiar with, hey, we get interest.
Yep.
1099 from CDs.
My dad had CDs and it was just like, Dad, you're paying taxes on these. We should have put this into a MYGA, because I don't think with MYGAs, do you get that?
Yeah. So I was going down that road with a client last week is, hey, Ashton, I've got $4,000 in interest for my CDs, and I'm a little concerned that, I don't need to pay tax on that. This is really money that's kind of never ever money I'm going to leave to my kids.
Yeah.
And so we could look at like a MYGA, which is a multi-year guaranteed annuity.
Yeah.
And there's two benefits to that. Currently, the interest rates are higher than most CDs.
Oh, yeah.
That I've seen by probably a couple percent.
Yep.
And then you can continue, if you don't need that interest to live on, you can continue to defer that interest every year. So you don't have to pay tax on it in that tax year.
Yeah.
I've got a client who, again, wanted to do a Roth conversion.
Mm-hmm.
And so, but he's like, well, we got $4,000 in CD interest. Well, we can put that into a multi-year guaranteed annuity, not have to pay tax on that $4,000. A new thing in 25, 26, 27, 28 is a senior deduction.
Yep.
And so he's 65 and his wife is turning 65.
So they get that extra standard deduction, the standard deduction, and now the extra of $6,000 each.
Correct.
Right? So
$6,000 each.
$12,000 they can deduct right off the top. Yeah.
And so we can take that $12,000, their standard deduction of $32,500, I believe, is what it is. And then if we take that CD interest and we defer it, now we've got $4,000. All of a sudden, we free up a lot of room to do what's called a Roth conversion.
Yes, because you have a lot of room in your tax bracket.
Correct. Now we've got 44 plus the other $4,000, roughly $48,000.
Yeah.
In standard deduction.
Yeah, and there's a $1,600 senior deduction that's still in play in addition to the $6,000.
Yeah.
Yeah, and so the standard deduction for those 65 and over is huge.
Yeah. And so I've been talking to a lot of those people in that age group who maybe don't need the income yet or not a ton of it. And we've been converting that traditional IRA into the Roth IRA.
Smart. Yeah.
I always try and tell my clients I'd love to pay as much tax as I can at 12% because that's a discount.
Yeah.
Again, nobody likes to pay tax.
No.
But if we can get it at a discount versus, a higher tax bracket, sometimes it makes sense for the clients.
Sure.
And then the other part of that Roth conversion is if they give an inherited IRA to their beneficiaries, those beneficiaries have to take it out over 10 years. And those beneficiaries may be in a higher tax bracket than the people that are converting that.
Yeah.
So.
And now we're really into retirement tax planning.
Yes.
Right. So we're talking about planning around retirement. And the closer you get to retirement, the more important this tax planning becomes, right?
For sure. And again, some of these people don't want to have to take their RMD at age 73.
Right.
They're talking about bumping that up to age 75. I haven't heard if that's official yet, but there was rumors of that. Regardless, you're going to have to take that required minimum distribution
at some point. And we're living longer and longer, and that's why they've bumped it up.
Yeah. Yep. It used to be 70 and a half. Then it was 72 during COVID times, I think. Then
now it's 73.
And it will be 75 down the road here.
Yep.
But I've got a lot of clients who we're looking at conversions to get that because you don't have to do that on your Roth IRA.
Right. No RMDs.
No RMDs.
And on an RMD, the government makes you take a pretty decent percentage out every year of your traditional IRA accounts and traditional accounts. You can't just leave it in a 401k or an IRA tax deferred for the rest of your life and into perpetuity or whatever you'd call it. So
again, for kind of an easy example, let's say we've got a client who's 65. They've got, call it 7 years, 8 years before they have to start taking their RMD. Maybe we convert $20,000 every year. Or, these next 3 years, we have that extra $12,000 in deduction for married couples, that senior deduction. Maybe that's a great opportunity to at least convert that much every year, since we're getting that additional deduction.
Interesting. So you have to look at RMDs, and you said Roth conversions. We've talked, those have pretty much the whole show. We've been mentioning them.
Yes.
So I think that's really good. Is there anything else we need to know about? I mean, they work. Roth conversions are great, but it depends on your situation.
For
right?
sure. Yeah. Yeah. Again, it's customized to each individual's situation. Some people, maybe it doesn't make sense because they already are in the higher tax bracket.
Sure.
Or maybe it makes sense for a couple of years when maybe you've just retired.
Right.
Your income's a little lower. You're maybe not drawing Social Security yet.
Yeah.
So it might make sense to do it for a few years, but it doesn't mean we have to do it all of it or every year.
Yeah. And talking about Roths and Roth conversions makes me think of you've mentioned the bucket strategy.
Yes.
So you want to make sure you have money for retirement in different categories that are pulling from different places. It's not even as much about how much you have, but where it's at. Correct. And when you're going to access it. So one of those buckets is a tax-free bucket, I would assume.
Yes. Yeah. And so again, that Roth is going to be that tax-free bucket.
Yep.
Again, it's nice to be able to pull from that when you have some larger distributions maybe that you need to do, whether that's a family trip or, hey, every 5 years we need to upgrade vehicles. It might be a good spot to pull from and without pushing in that next tax bracket. And then we've got that tax deferred bucket, which is going to be your traditional IRAs. And we also mentioned annuities. Those can also defer some taxes as well.
Yep.
And then we've got your non-qualified money, which is going to be the money you get a 1099 on every year. You kind of pay taxes as you go. And then, again, we've got options where we can try and minimize those capital gains and 1099s every year.
Yep. And when you withdraw it and from which bucket you take it from makes a big difference. That's called sequence of returns, that type of thing, right?
Yeah. I mean, part of it's a sequence of returns. And then, again, it's just having that flexibility for income in retirement to know, hey, which bucket are we pulling from and why?
Yep.
So for some clients, we just leave those lump sum distributions for the Roth IRA.
Yep.
And then we maybe send them that monthly income out of their traditional IRA.
Sure. So what do you want to touch on next? Okay.
Yeah. So one of the biggest mistakes a person can make is taking an early withdrawal from their retirement account.
Yeah.
Before 59 and a half for sure.
Yes.
And then before retirement, because we talked a lot about taxes, and that's going to be our largest expense. Probably our whole lives is taxes.
Yeah.
One of the largest expenses, whether that be in growth mode or earning years or in retirement.
Yeah.
But then on top of that, the IRS gives you a 10% penalty if you're going to withdraw. And so, again, let's look at an RV. Hey, we want to start traveling before we retire with our kids. Let's buy that $100,000 camper, RV, whatever it is, and we're going to pull it from our 401k. Depending on what tax bracket you're in, more than likely, you're going to end up paying that. You're going to pay that 10% penalty. Let's pretend you're in the 22% tax bracket. So now we're at 32% in federal taxes, and you're probably paying at least 8% state tax. And so now we're looking at that 100,000 is actually going to be 60,000 because we got to give Uncle Sam 40.
Wow.
And so again, it's one of the biggest mistakes people can make.
Yeah. Have you seen that happen? Ashton, have you come across people who have done that?
And thankfully, there's been quite a few people who ask me beforehand.
That's good.
And so we can have that conversation and they're like, oh, wow, maybe I don't need this RV or camper as bad as I thought I did.
You got to wait. I mean, I always just tell myself, and I tell my wife and kids, anything in a retirement account, anything in a 401k, 403b, TSP, whatever it is, IRA, Roth IRA, all of that money, those are retirement accounts.
Yes.
Those are just for retirement and cannot be touched before age 59 and a half.
There's exceptions to that, but again, ideally that is what they're earmarked
right.
for. Yes.
And they really shouldn't be touched before you retire, let alone, especially before 59 and a half, because you want to pay. I mean, you're just going to, it doesn't make sense. If you need $100,000, you'd need a lot more because you'd need 140
for sure. Yeah. Yeah.
And the more you take out, the more the taxes will be. So you can't take the tax money that you're going to pay in taxes out of the account either.
Exactly.
You get into trouble doing that.
Yes. Yep. Yeah. Yep. Yeah. And so again, it's I don't want to say a common mistake, but a mistake I see more often than I'd like to.
Yeah.
And again, thankfully, I've had a few people reach out to me before they make that decision.
Yes.
And then we talk about the consequences and they're like, oh, maybe I don't want to do that.
Which is why, again, work with a trusted financial services professional.
Exactly.
Yeah.
Yep.
Yeah. All right. Is there anything else you want to touch on today?
Yeah, I'm just going to touch quickly on one of the things I like to talk about is the three-legged stool of retirement income. That is.
Okay.
And usually those legs are made up of Social Security, which is often one of the largest legs of that stool. Another one is going to be personal savings, whether that's 401k, IRA, Roth IRA, SEP IRA, those types of things. And then the third leg is going to be pension. Not everybody has a pension anymore. But again, that's the three-legged stool of retirement. And so when you go to, with Social Security usually being the largest leg of that, when it's time to turn that on, you want to make sure that you're doing it and maximizing it.
Yeah.
And so again, sit down with a professional before you actually turn it on, because once you turn it on, you can't turn it off.
Right.
And so again, that's a big leg of the stool. And then
huge.
Often if most people don't have those pensions anymore, and so often we create a pension with maybe a guaranteed income type product.
Sure.
From that savings, whether that be that Roth IRA, 401k. And so again, we can help turn that two-legged stool into a three-legged stool and give you a nice solid foundation for retirement.
Right. Right. And taxes, I mean, you've got to look at everything. You've got to look at Social Security, any type of income when it comes to taxes.
For sure. Because
even though that $6,000 tax credit that you mentioned, additional tax credit for those over 65, it helps. And a lot of people then won't need to have their Social Security tax, but it still can be taxed if you if you have too much income in retirement or pull out too much money, right?
Yep, for sure.
Yeah. So you got to watch that. Well, we've covered a lot today.
Yeah.
I know that our listeners probably have questions about all this, and hopefully they will, and we'll ask you questions like, what's my personal situation? How does this apply to me? How can I make the best financial decisions and tax decisions? How can they get a hold of you and your office to set up a no-charge consultation?
Yeah, the best way to do it is to give our office a call, 952-873-2703. Visit our website, pankoninfinancial.com. That's PANKONIN financial.com. We're always happy to help give you a second opinion or just look at that customized plan for you.
All right. And for those listeners to the radio and the podcast, this episode is actually going to be on the YouTube channel.
Yes.
So they can go to your YouTube channel and look up Pankonin Financial Perspective, and they'll be able to see our shining faces. I've always been told, Ashton, that I have the perfect face for radio.
You do, Tony.
Yeah. Yeah.
Don't sell yourself short.
All right. All right. And that does it for today's episode of the Pankonin Financial Perspective with our host, Ashton Pankonin.
Thank you for joining us for Pankonin Financial Perspective. Don't head into retirement without a plan for both your finances and your health. For more information, contact Ashton Pankonin at Pankonin Financial Group at 952-873-2703 or visit pankoninfinancialgroup.com. Join us again soon for another episode of Pankonin Financial Perspective. Advisory services are offered by Ashton Pankonin LLC DBA Pankonin Financial Group, an investment advisor in the state of Minnesota.
All matters discussed during the show are for informational purposes only. Each individual situation may vary, and the opinions expressed here may not apply to everyone. Materials presented are believed to be from reliable sources, and no representations can be made as to its accuracy. All ideas and information should be discussed in detail with one of our qualified representatives prior to implementation. We are not affiliated with or endorsed by the Social Security Administration, the Federal Medicare Program, or any other government agency. Calling this number will direct you to a licensed sales agent.